A Tuesday morning, a push notification lights up a smartphone screen. The item is a 1-ounce, 24-karat gold bar minted by PAMP Suisse, stamped with the image of Lady Fortuna. The price is approximately $2,000. Within 4 hours, the digital inventory is completely wiped out. This scene repeats itself week after week, month after month. The merchant moving this institutional-grade bullion is not a specialized commodities broker or a Wall Street trading desk. It is Costco. Every single month, the wholesale retailer processes an estimated $200 million in physical gold sales. It is a staggering volume that briefly triggered an analytical frenzy in the financial press. On paper, it looks like a massive, lucrative new revenue stream for a company famous for bulk toilet paper and warehouse aisles. But the reality found in the margins tells a completely different story. Costco makes virtually zero profit on these gold bars. Once credit card processing fees, secure shipping logistics, and insurance liabilities are factored into the equation, the margin on a $2,000 piece of metal is a rounding error, hovering near zero and occasionally dipping into negative territory. Wall Street analysts look at the balance sheet and see a contradiction. Why would one of the most efficient retail machines on the planet voluntarily take on the immense logistical nightmare of physical bullion? Why absorb the risk of theft, the cost of armored transport, and the liability of lost shipments for a product that generates no net income? The answer is not found in the spot price of precious metals. It is hidden in the plastic card required to walk through the warehouse doors. The gold is not a product. It is a precisely engineered psychological trap designed to manipulate the most affluent demographic in the retail sector. By transforming a highly regulated, internationally traded commodity into a finite grocery item, Costco has weaponized scarcity. The $200 million monthly gold rush is actually a loss-leading illusion. It is a data harvesting operation and a membership retention mechanism operating under the guise of an inflation hedge.
To understand the economic anomaly of retail gold, you have to dissect the anatomy of a spot price. The global market for precious metals is ruthless, efficient, and dictated by instantaneous algorithmic trading. The spot price is the theoretical cost of raw, unminted gold sitting in a vault in London or Zurich. But ordinary consumers cannot buy gold at the spot price. When an individual investor attempts to purchase physical bullion from a traditional coin dealer or an online broker, they are hit with a premium. This markup covers the cost of minting, marketing, inventory holding, and the dealer's profit margin. In the retail bullion market, a premium of 5, 10, or even 15% over the spot price is standard practice. It is a tax on the amateur investor. Costco shattered this market structure overnight. They began listing 1-ounce bars from reputable Swiss refineries like PAMP Suisse and South Africa's Rand refinery at prices that barely covered the spot cost plus the minting premium. It was an institutional-grade pricing model suddenly made available to anyone with a warehouse club membership. The retail industry was stunned. For decades, Costco's business model relied on a concept called the treasure hunt. The warehouse floors are deliberately designed to be disorienting. Staples like milk and eggs are placed at the back of the store, forcing shoppers to navigate a labyrinth of rotating, unpredictable inventory. You walk in for paper towels and leave with a kayak, a television, and a bulk package of prime rib. The treasure hunt creates a psychological urgency. If you see a heavily discounted luxury item, you must buy it immediately because it will not be there tomorrow. Gold digitizes this exact physical phenomenon. By placing gold bars on their website and app at razor-thin margins, Costco translated the warehouse treasure hunt into the digital age. But physical gold is not a kayak. It requires an entirely different supply chain. The logistical reality of moving millions of dollars of bullion requires extreme security. Costco bypasses the traditional glass display cases entirely. The gold is not stored in the local warehouse. It is shipped directly from secure fulfillment centers to the consumer via insured courier, requiring an adult signature upon delivery. The sales are strictly non-refundable. This rigid framework eliminates the costly return logistics that plague traditional retail, but it still leaves the core contradiction intact. Even with zero returns, the margins are non-existent. SEC filings tracking Costco's financial performance show massive spikes in e-commerce revenue directly correlated to the bullion drops, yet the net income remains flat in relation to this specific sales volume.
The retailer is moving literal tons of gold, utilizing armored cars and secure facilities, effectively operating a massive currency exchange desk without extracting a profit. Traditional retailers use loss leaders to drive foot traffic. The famous $1.50 hot dog and the $5 rotisserie chicken bleed money, but they guarantee that a customer will walk into the physical store and inevitably buy a high-margin television or a set of tires. But the gold bars are sold almost exclusively online. They do not drive physical foot traffic. A customer buys the bar on their phone and waits for the delivery truck. The traditional loss leader arithmetic breaks down completely.
There is no impulse buy of bulk mayonnaise when you are checking out on a smartphone app. Therefore, the gold is serving a completely different economic purpose. It is targeting a specific blind spot in the consumer psyche. In an era defined by persistent inflation anxiety and a deep distrust of fiat currency, physical gold represents the ultimate safe haven. But the barrier to entry was always the sleazy reputation of late-night television coin dealers and the high premiums of online brokers. Costco leveraged its most valuable invisible asset, absolute consumer trust. They commoditized the safe haven, but they did it exclusively for a very specific subset of their customer base. The trust factor cannot be overstated. A consumer might hesitate to wire $2,000 to a faceless gold exchange in a different state, fearing counterfeit tungsten bars or shipping scams. But they do not hesitate to hand that same money to the company that sells them their weekly groceries. Costco weaponized this brand equity, stripping the friction out of the bullion trade. Yet by selling out within hours, they created a secondary market of media attention. The constant news cycle of sellouts acts as free global advertising. The typical Costco shopper is not the average American consumer. Demographic data consistently reveals that the warehouse club caters to a highly affluent base, with average household incomes significantly outpacing the national median. This wealth concentration is not an accident. It is the deliberate result of the membership toll booth. Within this affluent base, there is an upper tier, the executive member. For an elevated annual fee, currently sitting at $130, the executive member receives a 2% cashback reward on qualified purchases. This specific tier is the true engine of the entire corporate empire. While executive members make up slightly less than half of the total cardholders, they generate over 70% of the company's total sales volume. They are the heavy buyers, the small business owners, and the wealthy suburbanites. These are the characters driving the gold rush. When inflation spiked and macroeconomic anxiety dominated the headlines, this affluent demographic sought places to park cash. Real estate was bottlenecked by high interest rates. Stock valuations felt precarious. Physical gold became an irrational psychological comfort. But the target demographic is also highly financially literate. They refuse to pay a 10% premium to a retail coin dealer. They want the asset, but they demand efficiency. Costco recognized this precise psychological state and stepped into the void. They did not just offer gold, they offered it exclusively to members, creating an immediate sense of elite access. But behind the scenes, the gold transactions serve as a highly sophisticated data extraction tool. When a customer purchases a $2,000 gold bar on a Tuesday morning, they are signaling a massive amount of liquid disposable income. They are raising their hand and identifying themselves as an ultra-high net worth shopper. Costco captures this data point. They map the zip codes where the gold deliveries are concentrated. This granular data dictates the regional inventory of other high-margin luxury goods. If a specific neighborhood in Seattle or Dallas is suddenly ordering dozens of ounces of bullion, the local physical warehouse adjusts its inventory to feature Wagyu beef, premium imported wines, and high-end electronics. The gold buyer is the ultimate consumer profile, and Costco is willing to break even on the metal just to identify where these buyers live. Furthermore, the transaction cements a psychological bond between the consumer and the brand. The buyer feels they have outsmarted the financial system. They have secured a scarce, valuable asset at an institutional price point, leveraging their grocery store membership to beat Wall Street at its own game. This feeling of victory is intoxicating. It shifts the perception of the retailer from a mere purveyor of bulk goods to an essential financial partner. The customer is no longer just buying paper towels, they are securing their financial future. This deep emotional resonance ensures that when the annual membership renewal notice arrives in the mail, paying the fee is not viewed as an expense, but as a crucial investment.
The motives of the buyer and the seller align perfectly in a transaction where the actual product being exchanged is practically irrelevant. The obsession with hard assets during periods of fiat currency devaluation creates a panic buying mentality.
Costco taps into this panic, not by raising prices, but by holding them flat and limiting supply, thereby increasing the frenzy. The true economic brilliance of the gold operation lies in the exact mathematical constraints Costco places on the transaction. The strict policy is a limit of 2 bars per member. On the surface, this appears to be a simple inventory management tactic designed to prevent wholesale hoarding by secondary market dealers. If a local coin shop could buy 50 bars at Costco's near spot price, they would drain the inventory instantly and resell it for a profit. The 2-bar limit stops this arbitrage. But the limit serves a much darker, far more profitable purpose. It is the catalyst for the executive membership upgrade cycle. The mathematics of the transaction reveal the hidden engine. A standard 1-ounce gold bar is priced at approximately $2,000. A customer buying the maximum limit of 2 bars spends $4,000. If this customer is a standard member, they simply pay the $4,000. But if they are an executive member, they receive a 2% cashback reward. 2% of $4,000 is exactly $80. If the customer also utilizes the Costco-branded Citi Visa credit card, which offers an additional 2% cashback, they receive another $80. The total cashback on the transaction is $160. This creates a massive market distortion. The customer is effectively acquiring physical gold below the global spot price. They are buying money at a discount. This arbitrage opportunity is so mathematically compelling that it forces behavioral change. A standard member who wants the gold instantly realizes they are leaving money on the table. The math forces them to upgrade their membership to the executive tier to capture the cashback. The upgrade costs an additional $65, but the gold purchase alone yields $80 in rewards. The gold bar pays for the upgrade instantly. And this is exactly what Costco wants. The retailer is perfectly willing to subsidize the purchase of the gold, taking a temporary hit on the credit card rewards, because the lifetime value of an executive member is astronomical. Once a customer upgrades to the executive tier, their behavior changes permanently. They consolidate their spending. They buy their tires, their optical prescriptions, their pharmacy items, and their vacations through Costco to maximize the 2% reward. The renewal rate for executive members consistently hovers around 93%. They never leave. The 2-bar limit ensures that the purchase hits the exact financial threshold required to justify the executive tier, without exposing Costco to unlimited cashback liabilities on massive unlimited bullion orders. The scarcity also drives intense digital engagement. Because the gold drops are unannounced and inventory vanishes in hours, affluent shoppers develop a compulsive habit of checking the Costco application daily. They open the app while drinking their morning coffee, searching for the Lady Fortuna bars. Most days, the gold is out of stock, but the app is already open. The user is already logged in. And right beneath the out-of-stock notification is a targeted advertisement for a $2,000 OLED television, a luxury patio furniture set, or a heavily discounted MacBook. The gold acts as a digital magnet, pulling high-net-worth traffic into the e-commerce ecosystem at zero customer acquisition cost. The massive spikes in app traffic generated by the bullion hunters directly correlate to a lift in sales of high-margin, non-grocery items. The gold is the bait, and the electronics department is the hook. This creates a relentless flywheel. The media reports that the gold is sold out. The perceived scarcity increases the desirability. More affluent consumers buy memberships just for the chance to buy the gold. They download the app. They check it obsessively. They buy other items while they wait. When they finally score the gold, the cashback rewards force them into the highest membership tier, ensuring they renew their subscription year after year. The 1% margin on the metal itself is entirely irrelevant. The bullion is simply a customer acquisition tool disguised as a financial asset. The logistics of this operation are a marvel of market design. Behind the scenes, the supply chain is operating at absolute maximum tension. Moving $200 million of physical gold every month requires a flawless chain of custody. The metal is shipped directly from the mints to heavily guarded third-party fulfillment centers. It is never touched by the warehouse staff. The integration with UPS and FedEx requires specialized insurance riders and signature-required delivery protocols.
If a single package goes missing, the zero-margin equation flips into a massive financial loss. Yet Costco absorbs this immense logistical pressure flawlessly. They have engineered a system where the risk is centralized, but the psychological reward is distributed across hundreds of thousands of affluent households. The conflict is not between Costco and its competitors, it is between Costco and the rational bounds of traditional retail economics. They took the most primitive store of value in human history and turned it into a software-like subscription driver. When Wall Street analysts finally decoded the strategy, the reaction was a mix of awe and terror. Traditional jewelers and bullion dealers suddenly found themselves competing with a grocery chain that did not need to make a profit on the core product. The local coin dealer cannot subsidize a gold sale with a rotisserie chicken or an annual membership fee. They must extract margin from the metal itself. Costco's entry into the market effectively destroyed the pricing power of specialized dealers in affluent zip codes. The sheer gravity of Costco's balance sheet allows them to dictate terms to the Swiss refineries, securing massive allocations of bullion that smaller dealers simply cannot access. This forces the refineries to prioritize the warehouse club over their traditional distribution networks, altering the global flow of physical retail gold. The tension escalates as the spot price of gold fluctuates. If gold spikes to $2,400 an ounce, the